The Canadian government's latest mortgage reforms are a complete game changer, finally addressing the housing affordability crisis that has been plaguing both millennials and Gen Z homebuyers. By increasing the insured mortgage cap from $1 million dollars to $1.5 million dollars and extending the ability to have an amortization for a mortgage from 25 years to 30 years for insured mortgages, these very reforms directly tackle the financial barriers that have kept younger Canadian families from owning homes. And if you're someone who's considering buying a home and you don't investigate your options and you don't understand how these new changes are going to impact you, you risk being left behind as the market shifts. Now, don't get me wrong, these reforms are designed to help people just like you. But if you're not proactive, there's other factors at play here that you're also going to want to understand. These are things like lowering interest rates and competitive bidding wars if the market comes back to a place that it once was in 2021 or 2022. This could push home ownership further out of reach for some. Taking the time to understand these changes and how significant they are likely going to be on the market, especially in areas like the GTA of Ontario or in and around the lower mainland right here in British Columbia. This could be the difference between securing your dream home or watching the market just simply pass you by. Who am I, by the way? Well, my name is Darren, and I'm with the German Group, a real estate team here in Surrey, BC, serving the Surrey and surrounding municipalities. If you need to chat with a professional, you can hit us up by checking out the description in the podcast link, where you can book a time to speak with me or my team about your real estate needs. All right, so before we get into these changes and how they're going to affect the market, I want to paint a little bit of a story for you. And this is a very real story about some clients of mine, and we're going to call them Sarah and James just to protect the innocent. But this is their experience in trying to buy a home over the last 2 years. They're a young couple with a stable, well paying job. Both of them have stable, well paying jobs, in fact, and they also have excellent credit scores between the both of them. They've been saving for a home for years and demonstrating financial discipline and responsibility, trying just really hard to make it work. This is a problem that we have a young couple who has great paying jobs, good credit, and the intention to buy a home along with a big down payment that just can't get into a property that they want. The reason? They couldn't qualify for a mortgage because of the high down payment requirements and the limited access to 30-year amortizations, meaning stretching out their mortgage for up to 30 years, forcing them to sit on the sidelines, unable to take advantage of the current market conditions, watching homes that they absolutely were in love with come up for sale and just eventually be bought by other people. As you can imagine, this left them feeling way behind. The impact of these reforms on people like James and Sarah, they're absolutely huge. The increase in the mortgage cap from $1 million dollars to $1.5 million dollars now opens up options that were never available to them under the old regime. The expansion of mortgages from 25 years to 30 years, that just makes payments that much less expensive to alleviate their monthly carrying cost to own a property. And for the very first time, they feel empowered to act and are able to finally secure their dream home as of today. And here's the thing, Sarah and James, well, their story is not unique. They represent thousands of Canadians from coast to coast who have had similar problems under the old mortgage rules. There's many people that have been locked out of the market because of these. And well, that as of December 15th is all about to change. So, what are the two big changes and how are they going to affect somebody like you listening to this podcast? Let's dive into them right now. The first change is the cap for down payments for insured mortgages. So here's what happened. The cap for the down payment of insured mortgages has now changed from $1 million dollars up to $1.5 million. Dollars. So previously, what was the story? You used to have roughly about 7 to 8% in total of the total payment in down payment to buy a home up to $1 million. Dollars. But the problem was, as soon as that home for $1 million dollars became even $1 more expensive, you were now required to have a 20% down payment to buy that exact same home. The change in the threshold from $1 million dollars to anything even slightly above that automatically triggered the requirement to have 20% down. And this made it incredibly challenging for home buyers who didn't have monstrous sized down payments. Now, younger families and first time buyers in expensive markets like Vancouver or Surrey can consider homes that were previously out of reach. Let's put this into perspective just a little bit. What does this all really mean? Well, let's take a home in Surrey as an example that was priced at $1.2 million. Dollars. Previously, somebody wanting to buy that very home needed a down payment of $240,000 to get into it. That is insane. But as of today, well, they only need to have $95,000 of a down payment. And if you're doing the math at home, that's a difference of $145,000. It's estimated that about 20% of homes in Canada are priced between $1 million dollars and $1.5 million, dollars, potentially signaling a sizable boost to activity from this policy. The lower mainland market here in BC is disproportionately going to benefit from this new policy compared to urban centers and most provinces. So, with more and more buyers being required to enter the market at higher price points, obviously this means that there could be more demand for homes that are priced between 1 million and $1.5 million in the lower mainland or really anywhere in Canada for that matter. And of course, this could drive competition for a housing market that seemingly looks like it's progressively getting a little tighter each and every day. And hold on to that comment because I'm going to touch on that a little bit more later on. So, what's the second change that you need to be aware of? Well, that's understanding that you can now get a 30-year amortization on a mortgage rather than a 5-year. Now, there's some caveats to that, and let me explain what this all means. The amortization is just really the length of time that you can have a mortgage on a property that you buy and how long it takes for you to repay your entire loan. The return of the 30-year amortization for insured mortgages reduces monthly payments, giving buyers significant breathing room. In an effort to revive slumping pre-sales, amortizations will also be extended for the purchase of all newly built homes. This should offer some help and activity to the new home space, supporting housing construction in turn. And this isn't the first time the federal government has extended amortization periods. This isn't something new. In 2006, CMHC began a pilot program to begin insuring mortgages with 30-year amortizations instead of 25. That same year, this program became permanent, and CMHC also announced that mortgages with amortizations of 35 and 40 years could be insured. When I got my mortgage on my first property, I had a 35-year amortization. So they play with these numbers all the time. And that means that these changes will make a sizable change to the status quo from what we were dealing with prior to. There's no denying that lower monthly payments simply make owning a home much more accessible and affordable for everyone, even those with tight budgets. And speaking of making things more affordable, or at least keeping money in your pocket, more money in your pocket, if you're someone that's thinking of buying a home this very year, you're going to want to check out our download available in the description of this podcast, aptly named 21 grants and rebates available for home buyers and homeowners, available right now. All right, let's put this into perspective on how significant this change really is and use an example of someone who's spending $750,000 on buying their very first home. Now that they can choose to instead pay back their loan in 30 years rather than just 25, this is going to result in a savings of hundreds of dollars per month, money that they can put towards whatever they like. And ideally, they're going to put it back into the bank or back into the property, and lower monthly payments will likely lead to more buyers entering the market, which in turn could drive up competition. And this isn't all just good news for home buyers either. The sellers are going to benefit from this as well because now more buyers are able to enter the market not only because of the extended amortizations, but those homes that were priced between 1 million and 1.5 million. Well, the lower down payment is going to help make those homes much more attainable for many, many people. The surge in home sales in early 2024, after bond yields dropped a lot at the end of last year, 2023, and in the spring of 2023, when the Bank of Canada stopped raising interest rates, showed us that Canada's housing market reacts quickly to changes. However, I don't think these new mortgage rules alone are going to lead to a massive housing boom. Instead, they'll probably give a smaller boost to a market that's already improving into 2025. This is thanks to having lower borrowing costs and a slightly better economy. But here's the catch. As home buying becomes more affordable, home prices, well, they simply might go up, which could ultimately cancel out some of these benefits we're talking about in today's podcast. Clearly, we cannot predict exactly what's going to happen with prices and with the housing market, but it's clear that this is a positive step to help give the housing market a boost. With that said, more buyers entering the housing market, well, it's surely possible that home prices could rise as a result of that, among many other factors. And of course, I'm always curious what my listeners think. You can throw your opinion down in any comment section, whether this is on our YouTube channel or on our podcast channel. And if you found this information useful on the new mortgage changes, please consider sharing this audio with somebody that you know that's looking to buy a home in 2025. You can also find more information like this on our YouTube channel titled Living in Surrey and White Rock. I also owe you a little bit of an apology from today's podcast because I really haven't given you the full story. There's going to be some pretty significant considerations that you're going to want to make if you are considering buying a home in 2025. And we've got a video on our YouTube channel coming out on New Year's Day, as well as we'll also update this podcast here with everything that you want to know that could severely impact your decisions on buying real estate. You're going to have to stay tuned for the next episode to catch all of that. I want to thank you for listening and wish you an excellent and amazing start to 2025 with health, happiness, and prosperity. And we'll see you, or I guess we'll hear you on the next podcast. Cheers.